G'day everyone, it's Germanos from Reliance Accounting here. Hope you've been enjoying our video tips. We've got another one for you. It's been a crazy day in the office today. We've had a bit of a late night. I just finished a late meeting. And from this meeting came up with a bit of a video tip to come up with. Just finished this meeting with a client who's actually had a business. He's no longer in that business, he's moved out of it, and I'll come to the reasons why he's moved out in a bit of a while. This business was actually going quite well. He was doing quite a decent profit. Unfortunately, the reason why he's moved out is because didn't do the proper budgets and the calculations on that business. Now, that's a big mistake that a lot of people do. In one of our previous videos, we mentioned that it's best to calculate the costs of a startup business, see if you're able to afford those costs, make sure you know those costs so that way you can implement them as part of the quoting. Now, this one client, for example, knew the costs of his business in terms of material, labour and what have you. What he didn't calculate is, for example, additional costs such as bookkeeping and accounting and other costs such as government fees and what have you. It's best to speak to your accountant about that. Make sure that you've included all your costs so that when it comes time to quoting, you can actually quote the proper amount. Now, with this particular client, I've had this talk with a few other clients actually. Unfortunately, they've got a bit of debt in their own name. That may have arisen due to various other reasons, and they've needed to, I guess, stay on top of this debt. Now, having debt from various sources, being around about maybe $40,000, $50,000, $60,000, you can't get good interest rates on those debts. So these particular clients have had small amounts of debt scattered across different loan amounts, and those loans have varying interest rates, so varying from around about 15 to as high as 29%, believe it or not. So we got talking. Unfortunately, for example, on a $50,000 loan amount, say 20%, it's not cheap, the interest. The interest is around about, just say $10,000. $10,000 is a large amount. If you think about it, it comes up to roughly around about $900 a month. So think about that, $50,000, $900 a month in debt. Now, unfortunately, if you want to pay down this debt, and you're paying, say, $1,000 a month to cover the interest on this debt, you want to get rid of this debt straight away, don't you? So if you were to put an extra $1,000 a month on top of your repayments to cover the interest plus the extra $1,000, you're covering $12,000 of the loan amount of the $50,000. Now, at that rate of only extra $1,000 a month, you're paying $2,000 a month. And what's happening there is you're reducing the loan amount by $12,000 every year. So you could easily see that a $50,000 debt could take you anywhere between 3 to 4 years to cover. Now, a key thing that I did mention in my previous video is look at your costs of your business and look at your costs to see if your income will cover that. Another thing that I want to add is look at your personal costs. It's quite vital to look at them. Now, if you're in a position where you've got a bit of debt and it is starting to accumulate to the point where you're thinking, well, it's probably getting a bit too much, I'm not going to be able to cover it. Here's what I suggest you do. I suggest that you actually sit down and do a bit of the work yourself. Don't rely on the accountant. You need to do a bit of calculations yourself. Now, when I say do a bit of the work yourself, it's not complicated, it's not complex, it's actually quite easy for you to do. Sit down, grab a pen and paper and write down all your expenses that you have, whether it be personal or business. Write down whether it's weekly, monthly, annual. So consider car registration, car repayments, home loan, consider everything. Then calculate that to be either a weekly or a monthly figure. Calculate that, see if your income is enough to cover your expenses. Now, unfortunately, what I found with one or two of my previous clients is that they didn't realise. They would see, for example, that they had $15,000 in the bank. For them, that was a good ride. They had $15,000 in the bank. What they tend to forget is, for example, that they owed the credit card $20,000, they owed the personal loan $30,000. They have all these other amounts. Now, that $15,000, unfortunately, as good as it looks, gets eaten away so quickly when you calculate all the expenses and all the repayments. So if I was to suggest anything, once you've added up all your expenses, including your loan repayments that you need to do, sit down and see if that it will be covered by your income that you're expecting to get. Now, I don't know if it sounds complicated or simple to you. To me, as an accountant, it sounds quite simple. Now, another thing to consider is, okay, if your income is not enough to cover all your expenses, and trust me, these expenses could easily add up. A simple person could easily end up having anywhere between $3,000 to $8,000 of expenses every month when you include home loan and rental income. So it does add up, it really does add up. Someone on a $50,000, $60,000 salary might struggle to make those repayments, believe it or not. So on a, just say $50,000 salary, once you take out taxes, you're left only with $4,000 a month or so. Now, is your income enough to cover those expenses? Unfortunately, with today's economic market, people are having it tough. It is a bit of a struggle. Some people aren't paying their bills as quickly, and unfortunately because of that, you're not receiving your income as quickly. So that's another thing to consider. So what I ask you to do is, after you've mapped out your monthly expenses, to try to map out when you expect to receive your income. Now, if you're a wage earner, that's quite easy, because what will happen is you'll get almost the same amount every month, unless you get bonuses and commissions, or unless you have unpaid leave or what have you. If you're a business, it gets a bit more complicated. You need to sit down and try to work out when you'll be able to invoice the jobs, how quickly you'll be able to collect that money. Now, that's what could put undue pressure on businesses. Seeing when you can collect that money is a big concern. So having said that, I guess what I'm trying to reflect is that you need to budget. Whether you be in a personal situation or in a business situation, you do need to budget. It's quite key, and a budget is not something that's only done by accountants. It can be as easy or as simple to be done by you, and it needs to be something that works for you. It needs to be something that you understand. Now, myself as an accountant, I can easily help you with that budget. And all it takes is trying to set you up so that you understand what's happening, so that way you can then try to work it out yourself month to month. Now, for example, with one or two particular clients that I've got, what I've been doing is trying to work out how much the expenses are every month, how much the committed repayments are every month, and what the income is every month. So, for example, for one client, he's got a car loan of $1,000 a month. Now, $1,000 a month to him is a big amount, considering, for example, that he now nets only $4,000 a month. Once you include that car loan, once you include the interest on the debt, that's already half his income gone. When you include a bit of food and a bit of expenses, hang on, you're starting to eat up your income straight away. And if you have an unexpected expense somewhere, you're easily getting into losses. So what happens is, if you've got a $50,000 debt, if you continue at these losses, that could easily turn into a $60,000 debt. The next year, because you've got increased interest, will turn into a $70,000 and $80,000 debt. So this is quite key for everyone. It's quite a simple process to do, and I ask you to do it. It's very important that you do it. Make sure that you are in the positive and not in the negative. Now, if you are in the negative, what can you do? So with this client, for example, he had a $1,000 a month car loan. Now, unfortunately, his car's only worth $25,000 now. He's got a balloon of $10,000. So once he calculates the payout figure on his car, he has to pay out $35,000. So unfortunately, he has to come up with an extra $10,000 if he was to sell his car. So that's something to think about when you're going for a car loan. How much will the payout figure be at the end? Now, he's already got a work car because he's moved from his business to a place of employment, and they've given him a work car. So this 2010 model car is unfortunately sitting in his driveway, not being used at all. But he cannot afford to sell it because he can't come up with the extra $10,000. So what we've done is we've sat down, we've run the figures, and we've determined, okay, if you sell it, you've got to get, for example, maybe financing of $10,000 to pay out this car, for example. On that $10,000, interest even at 20%. It's a high interest rate, but just say we're worst case scenario, interest on $10,000 at 20% is, give or take, $2,000 a year. Now, if he was to sell the car, get a loan to pay out this $10,000 amount that is owing on the car, and he continued making $1,000 repayments towards his repayment debts, what's going to happen is that he will pay off this $10,000 plus the interest in a year to a year and a half. Now what happens there is that clears up at least $1,000 a month for him to start repaying down his other debt. And by repaying down his other debt, he's reducing the interest amount that is owing. And by reducing the interest amount, you're slowly bringing down that debt, which reduces the interest for future years. Now, with most personal loans or credit cards, unfortunately, the minimum repayment figure only barely covers the interest. So if you've got a credit card and you're only doing the minimum amount, I feel sorry for you, because you're really getting yourself into financial strife. So unfortunately, the best way to get this guy out of financial strife was to get him into further debt. Now, debt is bad when it's not managed. He is now working with me so we can manage his debt, so we can manage his repayments and get him into a way to reduce his debt. So I guess the point for you is budget, sit down, work out how much your expenses are. There are strategies to be done. Unfortunately for him as well, what I've recommended is, hang on, you need to get more work hours. So he's moved from being self-employed, not having a boss, to suddenly having a boss. It's taking a bit of an impact on him. But unfortunately, not only that, he's now having to consider other work. During these tough times, I guess what can I say? If you really want to get out of financial trouble, go find a job. It's a tough thing to do, but go find a job, go find more income. You need to find more income. Now, he'll probably work, for example, another job for a year, earn an extra $20,000. That will reduce his loan by $20,000. Now, the interest saved on $20,000 is around about $5,000. So that's around about $500 or $450 saved every month by putting that income from the other job on top of this debt. He's then paying off $500 faster. He'll then reduce the term of his loan from minimum loan repayments from 20 years, believe it or not, to only around about 3-4 years. So unfortunately, it is a tough ride for this particular client. And I did say I've got a few other clients in the same situation. I am helping them out. But sometimes you do have to look at doing the hard yards for around about a year or two. Now, this client, we've worked out, okay, if he works for 1 year, earns the $20,000, he'll get into a position where he's capable of paying all his expenses as well as the interest repayments. And if he continues at the payment arrangement that we've set, he will be out of financial strife in 3 years. Now, the reason why I brought this up is because a lot of people these days talk about bankruptcy and insolvency and liquidation. Australia is a great country. We've got this backup option, which is bankruptcy. Unfortunately, to go bankrupt, for example, over $50,000, you'd be crazy. You'd literally be crazy. The reason why I'm saying you'd be crazy is because you're setting yourself back for, say, 5 to 7 years. You can't get another loan. You can't progress. Every year that you fall behind and do not save money, I say you set yourself back 2 years. The reason being, if you had, say, $10,000 now, if you were to invest that and work it properly, you could easily turn that $10,000 into $20,000 in just, say, 5 years, for example. Now, if you're doing that every single year, in 5 years, 5 to 10 years, you could turn, for example, $10,000 a year, you could turn that into $100,000. So don't delay, don't set yourself back, don't go a year without saving any money, because unfortunately, during these tough times, you do need to save some money. That's a common thing. Don't pay your minimum loan repayments. Don't pay your minimum credit card. Get on top of things. The way to look at your credit cards is see which ones are the highest interest rates. Also look at which ones are the non-tax deductible loan repayments. So the first step that I'd look at is the highest interest rates. If you've got 29% or even 20% loans, concentrate on paying them off a lot quicker. So maybe stick to the minimum loan repayments for the debt that isn't so high in terms of interest, and then pay off those 29% very, very quickly. Because what happens at 29%, for example, because it's compounding interest, what compounding means is that you pay interest on interest. So because it's compounding interest, 29%, you could double your debt in 2.5 years. So a $10,000 loan at 29% in 2.5 years can become $20,000. Now your minimum repayments will double on that. So it's quite a scary figure. I say manage your debt. If you need help, if you want to have a chat, I'm happy to have a chat with you. Feel free to call us on 1300 135 918.